You are listening to Keystone's Stock Talk Podcast, episode 164. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. We are back, starting this week's episode with a discussion on interest rate hikes, the war in Ukraine, and more. In our Your Stock, Our Take segment, Aaron answers a listener question on Epam Systems, symbol EPAM on the Nasdaq, which provides digital platform engineering and software development services to companies around the globe. The high-growth software business has been significantly impacted near-term by the conflict in Ukraine. We give some details on what and how to proceed. I answer a listener question on CCOM Satellite Systems, CMI, and the TSX venture, which develops and deploys commercial-grade mobile auto-deploying satellite-based technology for the delivery of two-way high-speed internet, VoIP, and video services into vehicles and other areas. I give our current thoughts on this cash-rich microcap, which pays a 2.3% dividend. The listener wants to know, is there value once again in the company? Just before we went live with this show, a client asked for our take on Snowflake, symbol SNOW, on the Nasdaq, which sells data analytics and management tools that run on cloud computing platforms such as Amazon Web Services. I'll give you my quick thoughts on the company and the decline in the share price today. Finally, Brennan answers a quick question on Lucara Diamonds in a Your Stock Our Take, symbol LUC on the TSX. An independent producer of large, exceptional quality diamonds from its Caraway mine in Botswana. Does this profitable diamond mine producer offer value? He will let you know. So I'd like to welcome my co-hosts, Brennan and Aaron. How are you guys doing?
Doing well. Good morning.
Yes, preparing for our trip in about, a week, 10 days time to California to do our research to a research conference there in California. There's 500 companies. We're going to probably interview 40 to 50 management teams, and it'll be good to be back on the road, like we said.
Yeah, it'll be fun.
Before.
And there are a couple of companies that we've had under coverage for a few years that are going to be down there as well. So great to be able to sit down in front of those management teams. And it's been a while, so...
Yeah, haven't seen them face to face. Been a lot of Zoom calls and phone calls, but we'll get to sit down with the teams face to face. So it'll be interesting. And Brennan will almost get to do that for the first time, right?
Yeah, it will be my first time.
Yeah, I mean, I think you had some
Brennan's
meetings
never.
before.
Yeah, that's right. Brennan never went to an LD Micro conference with us down there or anything. So
this is Roth. Yeah, never been to any of those. So it'll be a new experience for you and. A learning experience,
for sure. And
as
you guys are definitely, Ryan's aware, I'm a little nervous to travel internationally by myself, but I'll figure it out. I'll
the U.S. is so darn international.
Well, for me it is. For me,
you're almost 30, Brennan.
I know.
Maybe now's the time.
It's, time to put my big boy pants on.
No, it's good though. It's good to get you out of your comfort zone, but it will be, the fact, but traveling with us can be a little
I think what's really going to build some character for Brennan is when we abandon him in some random city in the US and he needs to find his own way back without a passport or any money or resources of any kind.
I'll just cry.
That's really just a rite of passage. It's just a rite of passage to build some character. So
I think we may have done that before. We're just going to get an Uber and you'll be like, where are we driving to? Oh, we just want to show you the sites. And then we'll say, okay, get out here.
Last person
we
did that too. We never spoke to again. We never heard from him again, but hopefully
I see how it is.
Fine.
Yeah, there are some road stories, but we'll try not to get to them right now.
No.
It's like I said, just before we went live, a client asked for our take kind of on some breaking news on a company called Snowflake, symbol SNOW, so just snow on the Nasdaq. They sell data analytics and management tools that run on cloud computing platforms like Amazon Web Services or AWS. So for context, Snowflake pulled off the largest initial public offering or IPO ever by a software company in September 2020. Snowflake IPO, their IPO raised $3.4 billion. The stock has retreated just ahead of the earnings, the 2022 earnings, 22%. The stock dropped another 16, 18% today on the quarterly report. So, back in November, I think the stock traded up to, just under $400. Today, it's around $219. So almost, cut in half. Again, in the quarter, Snowflake, they offered stellar revenue growth, but it trades at a high multiple despite the correction in its stock since November. Again, like I said, on this quarter, that was on display. Strong revenue growth, losses narrowed, but we're still present. It's growing at its scale is tremendous. I mean, if you look back in 2019, its growth, $96 million in revenues, up to 2020, $264 million in revenues, 2021, $592, trailing just around $1 billion in revenue. So tremendous growth there. But you look at the valuations on the stock right now. The company there's no earnings, cash flow in this business. So on a price to sales basis, it's about 78 times on a price to sales basis. If you look forward, analyst estimates on this stock are looking for the company this is just on an adjusted basis, to report profitability in 2023. But, off of that multiple, I mean, the company trades at a massive amount off that multiple, in the hundreds off that multiple of earnings. And, looking forward, the price to sales is around 40. So strong growth. But when you have a miss on a company, and the miss is just that they did narrow their loss, but the miss here is that their revenue is projected to grow at a little bit slower rate than they had originally forecasted due to some reasons that are very explainable and reasonable. But it is going to grow at a slightly slower rate, still a very high rate. But when you trade at such a premium, the market is punishing you right now, particularly when you're not a company that's profitable or has a bottom line there and hasn't proven the ability to do that. So Snowflake, well thought of, very high multiples. Even with the correction, you're still trading at relatively high multiples. So that is why we continue to expect a number of these companies, even high quality companies in the software industry, that trade at such premium multiples. If there is any misstep, they will get hit hard in the market, and we continue to track that and foresee that going forward.
And this is just really where valuation does matter, because you could have a company, as you said, I mean, maybe it's growing its revenues at 50%, 60, 70%, and it gets a multiple that requires it to continue to grow at that pace. But very, very few companies can maintain that pace of growth for any period of time. So even if that growth rate backs off to 30, 40%, which is still a phenomenally high growth rate.
Just tremendous.
Yeah,
growth.
there's
still.
And probably very difficult to sustain for almost any company. Even if it backs off to that level, you're usually going to get a pullback in the share price and a revaluation of that high growth company. Yeah. So
again, we're not seeing a 10% pullback. We're seeing 45 to 60. You're seeing like massive pullbacks. And then at that rate, you're still looking at the company and saying, well, they better keep growing at 40%, right? Like that is how far valuations got in certain companies to the extreme premium. So, these companies, if you have any concern over, not hitting their growth rates, that's where you see some vulnerability.
Yeah. The Nasdaq 100, just as an aside, so this is a very tech-heavy index, the top 100 stocks in the Nasdaq. So it's down about 15% from its peak in November, and that's around November of last year, where we saw the tech sector overall, particularly in the U.S. market, peak. So about 15% down for the Nasdaq 100, but that doesn't really tell the full story, because a lot of the larger companies like the Microsofts, the alphabets, they're not down that much. They've actually been able to sustain their share prices much better. But we did put together, I know we've spoken about this in previous podcasts, we have put together a list of 40 of the highest growth technology companies in the US, profitable, growth-oriented businesses. And on average, they're down about 35-40% from that period of time. And in many cases, these companies are continuing to grow, and there's been, minimal impact or no impact to their growth strategy, but it's just their growth outlook. But it's just really a testament to how, these were some of the highest value companies in the market. Market starts to recognize that high valuation, that overvaluation even, and this is the type of loss that temporary loss, anyways, investors can experience when they stop paying attention to what a company is trading for on a price to earnings or price to cash flow basis.
Yeah, it just gives people a shot in the face that basically says valuations do matter, and we're seeing that, and we'll probably continue to see that throughout this year and going forward, as people are reminded that you just can't pay anything for even a great growth company.
And the Microsofts, ironically, the Microsofts, the Alphabets, some of these large tech companies, which are still amazing growth-oriented businesses that have not pulled back as much since November. These are companies that really, they weren't as expensive as a lot of the mid-cap or just regular large-cap tech companies. So they were still trading in that 30 to 35 times earnings range, even as tech multiples were peaking, whereas a lot of these other companies that have taken big hits, I mean, they're trading up to 60, 70, 80, over 100 times earnings in some cases.
Or times sales.
Like some of them don't even have earnings, right?
Another level. Yeah. Yeah. So do you want to move on to looking at some of the global macro issues?
Sure. Why don't we talk about that? I think it's important. It's on everybody's mind. Obviously, we've been getting a lot of questions about what's been going on in Eastern Europe, in Ukraine right now. Absolutely tragic situation, and I think that it's really taken people by surprise. I mean, I didn't expect. I think that the expectation was that there may have been some fighting, but that it would be more contained, maybe to the eastern border of Ukraine. I never would have expected this level of invasion from Russia, and I think that most people agree. And it's surprisingly hasn't really, and this is one of the questions that a lot of people have, is why hasn't it impacted the overall market more? And I think it's impacted certain segments of the market, but if you look at just overall market index, it seems to have really had a muted effect, which you would think, given everything that's going on there, the potential even possibly for it to expand outside of Ukraine. I'm not saying that that's really a reason, that's not an expectation, but there's a lot going on there. And then veiled threats, of course, from Putin talking about, his nuclear arsenal. So why hasn't had a larger impact on the market? And, it's really difficult to say, but there are a few things. I mean, certainly in Canada, energy makes up a large segment of our stock market. Energy prices have only gone up since the invasion started. So, Russia is one of the largest exporters of oil and gas in the world. The sanctions on Russia, that's going to restrict supply of oil and gas. So you would expect, those companies to not really drop that much. In some ways, certain areas of the market had already pulled back quite a bit before this started. So there may have been a lot of bad news already factored into prices. Some people are saying that with all of the economic uncertainty that this could potentially cause, that perhaps central banks aren't going to raise interest rates as much as previously expected. So that could also weigh into it. But it could even just be that the market is expecting, a quicker resolution, or is maybe not fully factoring in the full risks. What are your guys' thoughts?
Yeah, no, I just reiterate what Aaron was saying. Like, our hearts and our prayers and our thoughts go out to anybody affected by it in the Ukraine. Anybody who has family there, obviously. We're talking the economic side of it here, but there's a human tragedy side that that really is above any and all.
It's unimaginable. It's absolutely unimaginable. And when I said that it surprised me the level of of invasion that we've seen is I just couldn't imagine that. I mean, you're dealing with, a dictator. I suppose, anything's possible, but I just didn't think that it would get this far. And it's just absolutely, I mean, like many people, I'm following the news, and I'm sure you guys are. And it's just, I mean, it's heartbreaking what they have to go through, but the courage that they're showing is just absolutely incredible. I mean, it's absolutely incredible, the courage that the Ukrainian people are showing.
Yeah. And I think the points you went through as to why the markets haven't been, dramatically affected as of yet. The markets that are already been in correction mode. Here you're seeing some bump because of the price in energy in Canada, and just the fact that the global uncertainty may lead to less rates, and rates had been a big fear. I think those are the other thing would be. I mean, the markets have not. Military conflict has not been a major factor in market movements for decades. I think since the fall of the Soviet Union, really investors have enjoyed decades-long global stability in terms of military conflict. And, but this now puts kind of global relations back on maybe investors' minds. And can this lead to people thinking about like a second Cold War potentially? I think that maybe the markets just, haven't been used to that type of tension or the threat of war affecting them. I don't know if they're just not used to it or not used to or how it could play out, because it really hasn't played out. And we had 9/11, but it wasn't. It was a terrorist attack. I mean, you can classify it many ways. And the markets, opened that day significantly down when there was 4 days close of the markets, I believe, and then they opened significantly down. But in the, days following that, there was a significant recovery. And it was, in terms of the markets, they moved on from that economically faster than you might have projected. But there is now, for the last several years, we've seen, frictions between the rest of the world and China, the U.S. and China. Are those going to go away? Can there be another Cold War type situation? I mean, some of the impacts that I would see is, and we've already seen that Russia's the third largest producer of oil. Energy prices have surged. The United States and European allies have frozen Russian central bank assets held by U.S. financial institutions, making it harder for central banks to support the ruble. There's been sanctions essentially barring some Russian banks from international transactions. There's corporations that are, exiting Russia. BP, the oil giant, said it would exit its 20% stake in the Russian state-controlled oil company Rosneft. Norway Sovereign Wealth Fund, for example, one of the world's largest, said it would divest itself of Russian investments. So these are many of the impacts that are happening right now. So are we in for a period of sanctions and power diplomacy? It looks like we could be. I'm not sure. Or will there be so much pressure on Russia that you could see some kind of revolt within country?
That I think is the hope of all of these sanctions, that it disrupts Putin's power base there, and it makes him look weak, and it puts pressure on people to challenge him. Whether or not that will happen, I mean, it's
counter to that. I've heard people raise the fact that Putin's going to now, with his propaganda in country, say this is the West against us. This is what I've been telling you for all along. They're completely against us. Look at the sanctions. Look at how cut off we are from the rest of the world. In my opinion, that may work at a time where you don't have access to the internet and you can completely control. I don't think that his regime can control the message that much in a time where they can look on a cell phone and see that maybe this is not exactly what the rest of the world thinks, or what is happening in the rest of the world, and where it's being framed in the rest. So I'm not sure if that complete level of control and then completely controlling the message can be done today. I'm not sure if that can be done.
Yeah, I agree with that. I don't think it can. And like, I was even talking to my dad about that, and I went over and hung out with my dad, and that's what he was doing. He was holding up his phone saying, I think Putin has underestimated the power of these little devices. And I do think that. I mean, he can try to control it as much as he can, but it is pretty crazy, just what you can see online. And go on.
Well, I was saying your dad was holding up his landline. That was the difference, right?
No. He's actually got a newer phone than myself.
Probably than me too. So.
Yeah, he's quite the tech guru, I guess.
In any event, I really just think it's impossible to say, and that's leads to another question, totally. And that is, people have asked, should I just hold off on investing until there's more certainty? And I don't think that is necessarily a good course of action either. There's always a reason to hold off on investing. I think as long as you're putting your money into good, solid companies, if you have capital to deploy, you don't have to do it all tomorrow. You can space those investments out over a period of time. But the fact of the matter is, there's just no possible way. I mean, there's so many different directions that this crisis can move towards, both positive and negative. And if you're waiting for the best time, for the ideal time to put your capital to work for you, you'll be waiting constantly, because there's always a reason to be concerned. And also remember as well that cash is not a risk-free investment either, especially in a period of high inflation. So it's just really impossible to know what's going to happen right now. We just have to wait and see. Be cautious, be smart.
And our strategy all the time is if this is like, we have clients that come to us every day and say, I want to start investing, I want to buy some quality individual stocks, or I want to divest from my fund heavy portfolio. And what do we say? Well, you don't buy 25 stocks today. You're going to take 18 to 24 months, buy 2 to 4 to start, and then 2 to 3 every 3 months, and build that portfolio up. So if you're starting today and you're worried about the global situation, that is a way to start. That's the way you should start at all times, but it would be the same way to start now. And if you just look at UBS Global Wealth Management did some analysis on the S&P 500 since 1945, and they found that markets usually fell during the first week of key military conflicts, but in 14 of 18 cases, they rose within 3 months. So should you not invest now because you're fearful of what is going on? Well, in 14 of 18 cases, over the past, since 1945, the market 3 months later had risen. So, we're not exactly saying that is what is going to happen this time, but, if history being our guide, it's been actually a time to buy. And that doesn't mean you buy all 25 stocks now, but you can still start your portfolio. And there's, like Aaron said, there's always a million reasons not to enter the market. But if you look at what the market has done back 20 years, 50 years, 100 years, buying good quality businesses in the market over that time has been the right decision. And we think it will be if we look 10, 15, 25, 50 years going forward from here. So do we want to look at moving on from that, look at the Bank of Canada raising interest rates 25 basis points to 0.5%?
Yeah, certainly. I mean, we can touch on that. I think it was largely expected. Some people thought maybe due to the crisis in Ukraine right now and some of the global economic uncertainty, they might hold off, but they held off at the last meeting. Really, rates are so low, I think that they have to go up from here. Even if you just look over the past 10 years, and we've been talking about rates being low for 10 years, they're still sitting at almost historic lows, even over this period. Really, the only time they were lower was during the trough of the pandemic, where they got to absolutely bottom levels. But it's a lot of times when people think, a lot of people are thinking like, well, if the Bank of Canada, if the U.S. Federal Reserve are talking about increasing rates, then that means that they're going to continue to increase, and that we're not going to go back onto a trend of rising interest rates, which is not necessarily the case. I don't believe that that's going to be the case myself, without trying to predict where interest rates are going from now. They're at such low levels, they have to move up. Now, one of the reasons why people or the central banks are wanting to move interest rates up would be to battle inflation. Because as everybody knows, inflation has been a major factor, some of the highest inflation rates in the past 30 years. Now, to an extent, I think that may be successful, but there's going to be limits to their ability to combat inflation. In my personal opinion, a lot of the inflation we're experiencing is coming from,
particularly in the short term, right?
Particularly in the short term, cost push inflation, higher energy prices, higher metal prices, higher the supply chain issues as well. So really, there's going to be a limit to they have to do something to try and dampen demand somewhat so inflation doesn't get completely out of control. But there's going to be a limit to what they're able to do on the cost side of things. I mean, the increasing interest rates is not going to deal with the supply chain issues. That's not going to impact the supply chain and the extra costs from that. In terms of energy prices, the only way that higher interest rates are going to really have an impact on energy prices is if you completely decimate economic growth, which I don't think that they want to do. So yes, rates are going to come up a bit. I don't think that we're going to go anywhere close to historic levels, even over the past 10 years. And then, of course, people will ask, well, where does this put investors with respect to dividend stock? Should an investor avoid in putting their money into dividend producing companies if rates are going up? And my answer to that would be, well, if you're looking at a dividend stock that is very low to minimal growth or no growth and just pays a yield, then that's really a proxy to a bond. I can see those types of companies coming under pressure. Although when you look at the government bonds right now, a 10-year Canada bond is yielding about 1.8%. So if you want to get income out of your portfolio over and above inflation, you may have to gravitate still to some of these high yield, low growth companies to do that. But really, what we advise people to do is invest in companies, invest in dividend companies that are also growing. The business is growing, they're growing their dividends, and that really differentiates the dividend stock from a bond, which does not grow its coupon payments, right? When you purchase a bond, you essentially get the same coupon payment. But when you purchase a dividend growth stock, you're getting a nice attractive yield that is probably paying you far more than a government bond, and a company that's reinvesting back in its business and growing that dividend over time. So this is really what we would focus on. And as long as that business continues to grow, as long as there's a growth element, and in some of these cases, companies that we've recommended actually have indexation to inflation. So as inflation rises, they are able to pass that on to their customers just through contracts or regulated rates of return. So there are opportunities to invest in great dividend growth stocks, and then you mix those companies with some more growth-oriented businesses that perhaps don't pay a dividend. That's really how you build a portfolio that is positioned to do well in a variety of different economic scenarios.
Yeah, without a doubt. Even if you factor in 3 additional 25 basis point hikes, you get to 1.25%. Your GIC at 1.5 or 2%. Does that, even with the dividend companies that aren't raising, which would be the ones like Aaron said, that more proxy to a bond, that aren't growing their dividend over time, if they've got a 5-6% yield, does that even move the needle? Are you moving, well, I'm going to go with my all my money in a GIC versus getting 5 or 6% in a stodgy dividend payer? Again, we're not even looking at those companies, so it doesn't really even factor into our analysis. I mean, you're getting a company, say, with a 2-3% yield that's increasing that 10 to 15% every year. That's going to fight inflation. Those are the stocks we would buy, whether there's inflation, deflation, you've got a steady state. Either way, they're just good companies that are generating cash flow, growing their dividend. The fact they're growing their dividend tells you they're increasing their cash flow over time because that allows them to do that. Those are just great companies and businesses to own in any time. That's why we have you build that portfolio that way, regardless of what is going on in the market conditions. But it is good to talk about what is going on in the market and tell you why we're doing it this way on behalf of our clients. So let's get into our Your Stock, Our Take. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Do you want me to take CCOM, the first one, or Aaron, do you want to go into EPAM?
Sure, I can start off with EPAM here.
Sure.
Epam Systems. I'm going to talk about a company, Epam Systems here. So this is a company that is connected to the crisis in the Ukraine right now. And it's also a company that we've recommended in the past. We've had coverage on. I've talked about it recently because it is a tech company that has pulled back with the market. And it's something that I was keeping an eye on, potentially with the idea of reinstituting our buy recommendation. So EPAM, it trades at a price of about $220 right now. And what the company does is they're what we would refer to as a digitalization company. They provide software engineering services to their clients, which are enterprises and large organizations. And they essentially help their clients implement advanced technologies like AI and automation. Really what they're doing is they're helping their clients adapt to a digitalized world, helping them become more efficient and more competitive. So as I said, EPAM is a company that is very much involved in what's happening in Ukraine right now. The reason for that is that Ukraine is in fact home to a large percentage of the company's employees. So about 50% of EPAM's productive capacity was coming out of Ukraine. And one of the reasons why I'm talking about it today is because I have brought the company up several times over the past few months. And people have been asking me about it. I've received several emails about it and questions, phone calls. So I feel that it's probably a good time to just give some history of the company with respect to our coverage and how we feel about it right now, given the current situation. So our initially, we picked up coverage on this company back in November of 2018. We recommended it at about $123. It was a fantastic story, providing critical services in a high growth market and producing substantial cash flow. We did put a hold rating on the stock back in May of 2020, and this is partly due to uncertainties caused by the pandemic. And even management of EPAM, they had taken their guidance off the table. They saw a lot of uncertainties with respect to their own growth outlook. In addition to this, the valuation was also much more expensive than it was when we originally recommended. It was up almost about double from our original recommendation. So we felt there's a lot of uncertainty, there's higher valuation. We're going to put the stock at a hold. But even the company underestimated the need for its own services during the pandemic, and its growth only accelerated. The company last year grew its revenues, its earnings about 50%. It had hit a high back in last November before the tech sector overall started pulling back, a high of about $720. And this was a situation where we continued to love the business, but the valuation had hit frothy levels at its peak, about 80, 90 times earnings. So even though revenues were growing at 50%, we thought that was unsustainable even for a company like EPAM. And we put out a note at the end of 2020 instructing holders of the stock that we still like the company long term, but if you had made a strong return, doubled, tripled your money, then you should probably take some of the profits off the table, just even to rebalance the stock back in your portfolio. So this is a company that we were keeping a close eye on as it's been pulling back since November. As of about 2 weeks ago, the stock was down 35% from its high, and the valuation started to look a lot more attractive. Shortly afterwards, EPAM came up with their Q4 results. The numbers looked very good. The guidance for the current year continued to be strong, about 35% growth in revenue, 25% growth in earnings per share. And of course, the topic of the company's exposure to the Ukraine and a potential war situation there came up in the conference call. At the time, nobody was really expecting that the invasion would turn out like it did. The expectation was more for some fighting, perhaps along the eastern frontier. Nobody was really expecting a full invasion. So the company had a plan in place. They had stated that they had been dealing with conflict with Russia for basically 8 years since Russia had invaded the Crimea. So they had a plan in place, and they were still optimistic that they were going to be able to keep their people safe during this period of time, even if there was, even if a war did break out with Russia. Once again, expecting that it would not be anywhere near what we're seeing right now. So my thoughts at the time, I was a little bit worried, even though I also did not expect that things would turn out the way that they did, and that it would be a full-on invasion of Ukraine. I still was concerned about the situation, the uncertainties there. So I decided to wait. But I did feel at the time that $350 to $400, the valuation started to look more attractive. However, with this full-scale invasion of Ukraine from Russia and all of all of the destruction in the country, the everything that's going on, the stock has understandably taken a major hit as well. Understandably, it was down about 45% in a single day on Monday, and I don't think that is necessarily the market misinterpreting the situation. It is absolutely a tragic situation in the Ukraine, and I don't know. I would imagine that the vast majority of the company's software engineers in the Ukraine are not in any way focused on anything that the company is doing. I imagine that they are focused more on, the majority of them, the defense of their own country and the safety of their family and their fellow country people. So right now, I do think it is a very interesting company. I would wait until the next quarter to get an update from management. There's really a lot of uncertainties in terms of the services that the company provides. Absolutely critical. And I'm sure that they are offering some of these services as well to the government of Ukraine to help them. But right now, in terms of an investment, we would just continue to hold. Really a lot of uncertainty. We want to see what's going on. We wouldn't necessarily be buyers of the stock, but I'm 100% confident that the company will eventually get as many of its people to safety as possible. And over time, over the next several years, we'll rebuild any lost parts of its business. So, our hearts go out to all the people in the Ukraine, and we just really hope that the situation improves from here.
Yes, it's a good synopsis of a difficult situation. I'm going to move on to our second Your Stock, Our Take. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. On Epam Systems, symbol CMI, and the TSX Venture. Trades around 215, 214, market cap of around 87 million. This is a company that we recommended years ago when it traded back in the 40-cent range and subsequently sold. It's a good, solid business. The company's a leader in the development and deployment of commercial-grade mobile auto deployment satellite-based technology for the delivery of two-way high-speed internet, VoIP, and video services into vehicles. Now, let's look at the recent financials. The company has been hit during the pandemic. Epam's revenue dropped 42.9% to $1.01 million from $1.77 million in the third fiscal quarter. Revenues for the 9 months of this year were up around 61% to $6.57 million from $4.08. The company posted a net loss in its last quarter, about $157,000. Year-to-date, net income was $1.1 million. That compared to a loss in the same period of last year of around $400,000. Now, the company on January 11th did announce a $3 million U.S. orders for its iNetView antenna systems. So that is definitely a positive. The company sees rebounding sales and business from around the world in its 2022 fiscal year, the current year, so that is a good thing. The balance sheet here is solid. They have cash and cash equivalents of about $16.5 million with no real debt. So if we look at the valuations, we're going to take out that cash around 39 cents per share that is cash on hand. The company still trades at around 50 times trailing earnings. Now, again, we recognize that COVID-related slowdown has depressed revenues near term. It's likely that revenues and earnings pick up over the next 12 to 24 months. But at present, Epam trades at high valuations. Again, it's a solid business, pays a solid dividend. At this time, it's paying that from the cash on hand. As we said, it was negative in terms of profitability in the last quarter. They do continue to innovate and invest in the next generation of their products. That's what you can do when business is down and you have a good, strong balance sheet. And there's a number of strong patents in the business. And in a normalized period, the company has better cash flow. But we do see quarterly numbers being volatile overall. The results this year should be better than last year, But again, the company still trades at a premium. We will monitor the business, see if there is an entry point, but it's pricey on a trailing basis, given the lumpy nature historically of its quarterly results. We do see the company as a potential takeover target at some point, but do not recommend purchasing just based on takeover target potential, because that could occur 1 year from now or 10 years from now. So we'll monitor the company at this point. We don't think it's an entry point right now.
And one of the things that we tend to look for is we like to find companies where we have a good sense of where earnings and revenues are trending over the next 2, 3, 4, 5 years and beyond. And that's one of the issues with some of these companies that are more contract-based, lumpy, is that there's really a lot of volatility up and down. And it's difficult to know exactly. I mean, if you have a good sense of the competitiveness of their technology, that helps. But it's having, lumpy performance makes it really difficult to know where earnings and revenues are going to be 3 years from now.
Yeah, and if you look like that $3 million US orders that they're going to deliver over the next couple quarters, that will boost results in the short term. They need follow-on orders to continue that over time, and if we see those, then it starts to look more attractive. But if you get one great quarter followed up by a weak quarter, a great quarter, the market tends to not value those companies with a premium. Right now, it's getting a premium, likely because of the balance sheet there, and it continues to pay that dividend. And the market is looking for better results going forward. But we'd say that there's a little risk in these current market conditions that, and the orders have been solid in the last couple months, but they're not to the point where we would say that we can sustainably see growth for the next 2 or 3 years going forward, which we'd need to see to be a buyer. Brennan,
yes,
you're going to take your stock, our take on Lucara. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
You betcha.
And your favorite sector, the diamond sector, right?
Yeah, I do like the diamond sector.
Brennan's in the market for diamonds.
Yeah.
Well,
diamond rings.
I wouldn't say. I wouldn't say yet.
They're girl's best friend, Brennan.
I would say that Ryan's prediction is going to be wrong here for me acquiring a girlfriend over the year, but we'll see.
Let's not get into that.
The year's young.
I'm right. I think I'm dead right. So that's all. Let's go.
Yeah. Okay, so Lucara Diamond Corp, LUC, on the TSX, currently trading at a price of about 68 cents and has a market cap of about $317 million. So Lucara is a leading independent producer of large, exceptional quality Type 2A diamonds from its Karowe mine in Botswana, and it also owns a 100% interest in Clara Diamond Solutions, a secure digital sales platform positioned to modernize the existing diamond supply chain and ensure diamond provenance from mine to finger. That's definitely becoming a more important thing, is people want to know where those diamonds are coming from, actually. So looking at some key points here. In the fall of 2019, right before the outbreak of the COVID-19 pandemic, Lucara suspended its regular dividend with the announcement of a positive feasibility study for development of an underground mine at Karowe. So they're going to be using that cash that they were paying out in a dividend to help fund this. Now, the Karowe Underground Expansion Project will extend the mine life to at least 2040 and will add approximately $4 billion in revenue over its life. The company's board of directors formally approved the project, which has a $534 million capital cost and a 5-year construction period. And the mine ramp up is expected to be in 2026. And the company is funding this with quite a bit of debt, where they have recently secured a $220 million senior secured debt facility. And then as well, just recently, they did do a couple of equity financings, which were closed, that generated net proceeds of about $31.3 million from the sale of 55 million common shares at a price of 75 cents per share. Now, compared to 2020, the diamond price recovery began in the fourth quarter of 2020 and had largely improved to pre-pandemic levels by the end of 2021, owing to strengthening diamond jewelry demand against a backdrop of declining global supply. So that's what I do think is interesting about the diamond sector, is just what I said there, that backdrop of declining globally mined supplied diamonds. So the diamond market is very dynamic and has changed drastically over the last decade. So number one, we are seeing lab-created diamonds enter the market and grow at a significant pace. Now, people must understand that these lab-created diamonds are literally perfect substitutes. They are just compressed carbon. So there's nothing different about them from a mine diamond other than just that they're created in a lab. These diamonds are also cheaper and they don't have, the sustainability implications, and they are starting to take a share of the market. So in 2018, lab-grown diamonds as a percentage of the total diamond market were about 3.4%. In 2021, Paul Zimnisky, a diamond analyst, says that it was about 7.5% of the overall market. And in 2025, the forecast is that lab-grown diamonds are going to be about 11.5%. So they are, starting to eat up some market share. Now, number two here, looking at the diamond market, rough diamond supply is at a multi-decade low because of mine closures, such as Rio Tinto's Argyle mine, which was in operation since the 80s, which recently just closed in 2020. Now, this low supply is anticipated to remain relatively low through 2027, as there are very few new diamond mines anticipated to come online through this decade. That's the interesting thing, again, about diamonds, is there's not that many mines out there in the world. I believe there's just over 30 some mines actively in the world. So it's a little bit easier to forecast supply going forward. So looking at the company's recent financial results for Q4 of 2021, revenue was $57.9 million, an increase of 37% over the previous year. And this was primarily, due to pent-up demand, as well as the average price per carat sold increased to about $560 per carat, a 39% increase over the previous year. Net income was $1.7 million compared to a loss in Q4 of 2020. And fiscal 2021, so this is for the full year, adjusted EBITDA was about $102.5 million. The company has about $27 million in cash, and debt was $46.7 million. And on a valuation basis, they are trading with a trailing enterprise value to EBITDA multiple of just 2.5 times. The company did provide some 2022 revenue guidance of between 195 to 225 million, which would represent a slight decrease from what they posted in 2021 of 230 million. So our take here. Now, Lucara and the current state of the diamond industry definitely fascinate me. First, on the diamond industry, demand is strong coming out of the pandemic due to pent-up demand and consumers' desire for diamond jewelry. And on the supply side, we are seeing cheaper lab-created diamonds, which are a perfect substitute to mined diamonds, begin to grab market share, all while mined rough diamond supply is expected to plateau through the end of this decade due to limited new diamond mines coming online. Now, with Lucara specifically, on the other hand, the company trades with extremely low valuations and has a path to growth ahead of it with its underground expansion project, which will extend the mine life to at least 2040 and is anticipated to come online in 2026. Now, though the company does have work ahead of it to fund the $500 million capex of the underground project and will likely have margins reduced in the mid to near term because of this expansion, considering both the demand for diamonds and the dwindling supply of real mine diamonds, I think there could be a case to be made that the stock offers value in its current range. It is, however, a high-risk stock. The diamond industry is changing with lab-created diamonds, but it is of my opinion that mine diamonds will remain a significant part of the industry through the end of this century, especially large, high-quality stones such as produced at Caraway. Now, the last thing that I do want to just add, I didn't write this down, but it kind of brings it full circle to the war in Eastern Europe. Now, there are three primary diamond players in the market. That is Russian state-owned El Rosa, which owns about 28% of the market, De Beers, and then Rio Tinto. The sanctions on Russia and El Rosa, could potentially make some more implications for the supply in the world, just depending on if they're not able to supply their diamonds to, the world in general. I don't know what those sanctions would do, but it is going to be interesting in at least the near term what those sanctions could do to the diamond market and potentially push up prices even more in the near term. But yeah, it's an interesting business. They could have the wind behind their sails, but again, it is, relying on a commodity. And there's definitely risk there. There's no doubt.
And certainly a concern, as you mentioned, that artificial diamonds are starting to become more economic and more widespread as well.
Would you care, Aaron, if it was a lab-created diamond or mined diamond?
I'm not the right person to ask. The question is who's getting the diamond, right? They're the ones that...
well, somebody may propose to you someday. Right?
I'm already married, so the answer would be no. Yeah, I mean, it really comes down.
It as a buyer, would it matter to you? And I get.
I would have to ask the person that I was giving it to. Yeah. Like if I was buying a diamond.
You know what? This is a project. You go ask, and then. But Brennan, would it matter to you?
Probably not, especially if I was going to save money, or my significant other was going to save money, Yeah. But it is an interesting question, and I even remember bringing it up to you guys in 2019 and asking you guys that, and. It is.
I do wonder.
Yeah,
I do wonder if like millennials, people who will be, and like my son's generation, right? Yeah. Like whether they will be Eric's generation, whether they will care. I'll ask.
You may even get to a point where people prefer artificial diamonds.
Yeah, because it's not, there's no blood diamond, totally. Right? There's no, and can it be preferred? So if that happens, I think the mine. I mean, it costs a hell of a lot more to produce it that way, as far as I understand, right? Even if you're producing like these, or you're finding these massive diamonds that Lucara can find. I mean, I think that on a valuation basis, on a price to earnings basis, it looks interesting right now. But I have to say though, funding that $500 million capex right now, it's not the best time for this company to be going to the market. I mean, you look at the stock price in the last 5 years. 5 years ago, the share price traded just around the $3 range, right? And when does, even back in 2019, it traded it's just 2018, it was in the $2 range. 2019, $1.50 or above, and it's just this is one of the lowest rates, other than right at the basically when the pandemic hit. The lowest price it's traded at. If you're using equity, you're diluting far more than they would have if this project was done 4 or 5 years ago, right?
Totally.
So, I mean, its price earnings ratio looks quite low right now.
Yeah, it does.
It looks quite attractive, and from the bounce back. But you have those two things: is the market balancing. Wow. Are lab-created diamonds going to really push forward and become a huge part of the market? And they can be created far easier. And does the sentiment shift towards the next generation actually prefers the lab to the mined diamonds that create many issues, right? Environmentally. So,
for sure.
Anyways, it's something to keep in mind.
I could just add one more thing. It is kind of interesting, and I've read papers on it where De Beers, to try to protect the natural value of, or to protect the value of mined diamonds, they're kind of doing a predatory pricing strategy. They ended up coming out with their own lab-created diamond line called Lightbox, where they're selling about, I believe it's 2-carat diamonds for about $800. So they're really trying to undercut the market. So it's interesting, seeing another step in De Beers' marketing playbook. Who knows if it will be successful? In my opinion, I do agree with you guys, where I kind of think that lab created diamonds will become will surpass naturally mined diamonds in the future. I do think that will happen, and mined diamonds might become more niche. But yeah, it's definitely interesting to look at, De Beers' marketing playbook and seeing how they've came out with Lightbox, and they're really trying to preserve that, the price premium right now for mined diamonds. But who knows what will happen to that premium going forward.
Yeah, it's quite the tactic. Okay, well, I think that closes off our show. Keep your questions coming into our Your Stock, Our Take segment. We'll answer questions on and debate individual companies if you send those questions in. Thanks for sending us in. Rate and review us on iTunes. It helps us produce this content on a weekly basis. Again, I'd like to thank my co-hosts Brennan and Aaron for hosting with me, and I wish you, as always, profitable investing. Thank you.
Thank you, everyone.
Thanks, everyone.